Welcome to Mortgage on My Mind, where we take the mystery out of mortgages and make dreams of home ownership a reality. I'm Natalie Salins, a top 1% mortgage broker with 20 years of experience, based right here in sunny Los Angeles. If you've ever wondered about pre-approvals, appraisals, or what loan product is right for you, don't worry, I've got Mortgage on My Mind, so you don't have to. Each week, I'll bring you expert advice, real-life stories, and insider tips to help you navigate California's competitive real estate market with confidence. Whether you're buying your first home, refinancing, or just curious about how it all works, this podcast is for you. So let's talk mortgages, demystify the process, and make your real estate goals a reality. Ready to get started? Let's dive in. Hey, everybody. Welcome to Mortgage on My Mind. We have a fantastic... Do that again. Hey, everybody. Welcome. Welcome to Mortgage on My Mind. We have an incredible guest with us today, Jake Clopton. He is a serial entrepreneur. He is an esteemed author and economist with a deep expertise in commercial real estate finance, which is something that we don't normally talk about. And if you are a regular on the show, we haven't really talked about commercial financing at this point. He is the founder and the president of Clopton Capital, a Chicago-based firm specializing in innovative funding solutions for commercial real estate projects. And since founding Clopton Capital in 2010, he has facilitated billions of dollars in real estate loans and is renowned for creative financing strategies, which everybody knows is kind of my thing as well. So welcome, Jake. Thank you for being here.
Thanks, Natalie.
Yeah. Yes, absolutely. So tell our audience a little bit about the difference between commercial financing and like a regular residential financing.
Yes. All right. So the first thing right off the bat that usually jumps out at me, and actually usually I can tell when somebody's coming from the residential world, the first thing they'll ask me for is like a pre-approval. That doesn't exist in commercial real estate, right? So like in residential, you go and like you get a pre-approval for a mortgage, right? And it's 100% really based on your income, right? I qualify for X loan numbers. That's not how it works in commercial real estate. So if you think about residential lending, it starts with the borrower and then goes to the property. Whereas commercial real estate lending starts with the property first.
Right.
And then depending on what type of capital source, that will determine how extensive an underwriting you do on the sponsors, the borrowers, to the extent where like sometimes there really isn't any underwriting on the borrowers themselves when you get into like non-recourse lending. So that's the biggest difference that I think is kind of a gap of understanding from people that are coming from the residential world to commercial. And it's that pre-approval aspect, right? But you can see how there wouldn't be a pre-approval that exists in commercial real estate, seeing as you start with a property and you don't know what that is until you have identified it and bring it to me, right?
Right.
That's the biggest difference.
Right, exactly. Whenever I've explained it to clients, I'm always like, your down payment is what qualifies a property really on commercial.
To a degree, correct.
It ends up being how much does it make and how much does it cost? And where is the gap?
Right.
And that's kind of how it qualifies for itself.
Exactly. And in commercial real estate, kind of the way, I guess one way to explain it is you have multiple sources of repayment, whereas in residential, it's only you, right? The house itself is a liability, not really much of an asset, because the house costs money. So you're not getting repayment from there.
Totally. We have, which I'm sure you've heard of, we have programs in residential world called DSCR. Yep. Which it's the same thing, debt servicing credit ratio. So it's based on whether or not the rents cover the mortgage, the PITI.
Yep.
And we don't need any documents. It works just like commercial loans. We don't need any documents from the client. It's all about the assets as the down payment and if it covers the rents or not.
Right.
Yeah.
Yep.
Yeah. Excellent. And tell me, so you've written books or a book? Or...
yeah, so we did. I did write a book a couple of years ago. It's basically like, if you wanted a crash course in commercial lending, take a look at it. And it's also like, there's got some background in there in like finding and identifying deals and different ways to find property and stuff like that. It's very much geared toward, it's basically finding deals in today's market is the name. It's geared towards somebody that maybe is getting into commercial real estate lending and it really gives them an outline of like all these different loan products and capital sources and ways to find deals and stuff like that. I mean, the thing is, in residential lending, you have only really a couple different types of lenders, I would say, and they're all pretty similar to a degree. But in commercial real estate, you have so many different types of lenders. I mean, banks, credit unions, securitized lending, debt funds, life insurance companies. I mean, it just goes on and on. And, each one of those lenders in those categories is different, right? When you go from just one bank to another, their loan program will be completely different. And their credit standards will be completely different. So when we bring a deal to market, like now you're a broker, right? So when you bring a deal to market, you probably go to, I don't know, a dozen lenders or something like, I don't know, or you guys are in-house. But, on the real estate side, I may talk to over 200 bankers on every deal. And one of the most interesting phenomenons in my industry is I'll talk to 3 bankers at the same bank and get 3 different answers. So it's
why is that? Like, why is there no standard? Like
well, okay, so let's say I talk to 3 different bankers, right? I'll get one guy that I don't really want to work on that deal. I'll get another guy that's on vacation. I'll get another guy that says, I don't know, I don't think my credit guy will go for it. And then I'll get another guy that says, you know what? I just did a deal similar to this. I know how to talk to my credit guy about it and I can get it through. It is very much so kind of like an art form. And I really kind of say like this business is 90% presentation, right? It's like how the deal is properly presented is about 90% of whether or not it's going to get through. And it's very much so a relationship business. That's why I tell a lot of people, like if you're in commercial real estate and you're doing something that's not off the wall, right? And you're having trouble getting the right answers, maybe it's not being presented the right way. It's just kind of keep going because you might talk to 1 or 2 banks, but they're not the end answer, right? I mean, again, on every deal, I'll talk to maybe 200 people, but that would be difficult for the average person to do. But I've been doing this for 18 years. We know how to do that, but that's sometimes what it takes to get it done.
Right. And what are some of the biggest challenges you've seen? Like, what's a really hard deal that you were just like, that you ended up getting through, but that the roadblocks? I know some from small things that I've done, but like, what are the main, what do people watch out for when it comes to commercial lending?
So, okay, so I'll chop that question up. I mean, the hardest deal I think I've done was we do some really creative, like complicated deals. Like I do deals that have like historic tax credits and all this stuff in them. And they're in like difficult areas and, equity coming from brownfields and cities give away property. So that's a whole different category of lending that we really do. And that's just putting together the puzzle, right? There might be like 4 or 5 different lenders. That's definitely the hardest stuff that we do. But as far as like, someone coming into like, this is kind of what I say to people that, let's say they're buying some like single family homes as investments and want to step up to like commercial real estate, like 10, 20 units, right? There's usually 2 things I tell people. It's one, don't believe what's in the broker package, the sales package. Actually research those numbers yourself and get bank statements from the sellers to make sure that, like those numbers are legitimate, like the renters are actually paying that money and all this stuff. I've seen so many times, you get like a really nice looking underwrite on this broker package and then you get the actual numbers and it's like nowhere near there. Right, because there's just way more expenses, or there's the old tax numbers, or
the leases isn't like a big thing. Like the leases are ending soon.
There can be a lot of rollover, right, in the leases, or maybe it's fully occupied, but half the property isn't paying rent, right? So you're going to go in there and have to evict half the property day one.
Right,
that stuff happens, right, and it happens to usually the more inexperienced people who have less of an ability to understand how to navigate that when it does happen.
Right.
The other part of this kind of goes along with that, and that really understanding that this is not a investment. It's investment real estate, right? But I like to tell people like, hey, don't think of this as an investment. You're going to put your money in it, and it's just going to send you checks in the mail. This is an operating business, even an apartment building, right? And you can't just sit back and expect everything to go right. Stuff is going to happen, I mean, the fires are going to happen. Tenants are going to leave. You're going to have to evict them. It's constant maintenance. And it really is an operating business and you have to treat it that way or you're going to end up in a tough spot. right? So like the people that I see that run into problems, their assumptions were wrong going in for how the property is going to perform. And
Right.
then they didn't really operate the property as a business and kind of thought they could sit back and either just let some other property manager do it or, treat it like just mailbox money, which it's most certainly is not.
Right. Right. Interesting. Yeah, I know that, a lot of people get into investment properties or units, such as myself even, because you think it's some sort of passive income, and it's anything but passive income, of course.
Right. It's kind of like
No.
flying an airplane, right? It's like, hey, as long as the autopilot's on, anybody could do it. But as soon as a duck flies in the engine, which happens a lot, so you really got to figure it out. I mean, I own property too, and I've owned property, and like, it's for some reason this stuff always happens on a Friday night. Like, some guy will kick his girlfriend's window in and throw a Molotov cocktail at it. I mean, stuff like that happens, and
It does, yeah. I know. I've been at the property with police at
Yes.
2 a.m. once. Yes.
yeah. So it happens, that story is true, by the way. And you gotta know how to deal with it. So.
I don't even want to get into mine, why I went to the police, because it's something like that and even a little worse. Yeah. But so do you also fund triple net properties?
Yeah, so we really look at anything commercial.
I think those are the coolest. They're slower, they're not as aggressive, but I just think they're great properties.
They can be.
I'm wrong.
No, it's not that you're wrong, but I think some triple net properties are sold to people and they think that just because it's triple net, that it's like investment
Pure
grade.
passive.
You know what I
Yeah.
mean? Which that's not the case.
Do you want to explain what triple net is?
Like triple net is there's basically no landlord responsibilities, right? So a good example of triple net properties is like a Walgreens.
Right.
Where
KFC, McDonald's.
exactly. It's a single purpose or single use building. There's one tenant in there, usually, right? I've seen lots of others that have multiple tenants and there's triple net leases.
Yeah.
But they can be great for people because there's not a lot of landlord responsibilities. And usually they're just one tenant.
They're like 20-year leases.
Yeah, stuff like that.
They are responsible to pay the taxes. If the roof
True.
caves in, they're responsible to fix the roof. It's like this incredible, like they are in charge and responsible for the building.
True. The complication comes into it. What if that tenant leaves? Right.
Correct.
Then there's something called binary risk, right? That I hear a lot in single tenant triple net lending. And it's like, it basically means like they're either there or they're not. And if they're not, you're on the hook for everything.
Yeah. And you're not getting your every month paycheck or whatever.
Right. It's the same reason a lot of people don't like single family house rentals as investments until you get like a sizable portfolio, right? Because if like it's very binary, they're there or they're not. And when they're not, you're on the hook for paying everything. And you have to find another tenant. And that can take a while, right?
Yeah.
Especially triple net properties. I mean, single family
Triple
home
net can really take a while. Single home you fill within like a few weeks.
Right. Because like you mentioned, like KFCs or something like that. Like it's a very special use building.
Totally.
And if you can't find another quick service restaurant to go in there, what else can you do with it?
Yeah. But that's why they're more expensive, right? So some are more expensive because they have 18 years left on the lease. And then some are cheaper because they only have like 3 or 4.
If there's like investment grade credit attached to it, right? So like Walgreens, you can look up their credit rating in like a corporate lease, stuff like that. But a lot of these, quick service restaurants are just franchises actually. And, some people get into those thinking that it's like some like corporate guarantee or something, but it's really just some guy that has 2 locations. So you got to be careful with some of that stuff, and like what's actually backing the lease. Because if it's really just like, I see this a lot in the like childcare space. You'll get lots of triple net stuff, and it's got the big corporate name on it, but it's actually just a franchisor that may really only have like 1 or 2 locations.
Interesting. And do you finance those? Like, I know that financing triple nets normally mean that you really don't earn much at all because the monthly isn't necessarily like triple net leases normally build every year. So like the first year you earn this much, second year it goes up by 5%, third year it goes up by 10, fourth year and like every year the triple net builds.
Right.
And so your monthly, like I have a friend that bought a KFC in Tennessee. This is like 15 years ago though, but he got it for like 550,000.
Oh, okay. There you go. Nice.
Amazing. For me, I thought it was amazing, even though if you think about it, so he didn't finance anything. He's like, it doesn't make sense for me to finance because the first year he only was set to make 58,000. So basically he gets a check for $5,000 a month. But the second year,
That's a pretty good cap rate on that deal that
Is
he got.
it?
Though. Yeah, I mean, what's that, 10% something? Yeah.
not
If
on
he's getting
five-
580,000, he's getting 58,000 a year. It's not bad.
Yeah. But then it goes up. So the next
Right.
year, but you have to like think about it on like if you have 550,000, can you earn more somewhere else, right?
Sure.
But every
I mean,
year it was
15,
going up.
15 years ago, that might have been market, but like in today's world, I know a lot of people that would do that deal.
It's true. It's really gone down.
For
Like
sure.
those cap rates have really come down. But 15
Yeah,
years
in
ago,
today's world, that would be like half that.
it's true. I know it's crazy.
Yeah. So the other part of that, what I often see with triple net properties is you run into this like negative arbitrage because let's say you're buying something at like a 5.5 or 6 cap, which a lot of triple net properties go up, but
Sure.
rates are higher than that, right?
Right.
And you borrow money to do it. So you're borrowing money at a higher rate than the return of the asset you're getting.
Exactly. That's why he had said it doesn't make sense to finance because I was like, ooh, can I buy a triple net and finance it? And he's like, it doesn't make sense to finance on it, Natalie, because
Right.
you actually end up in the negative when you finance.
Yeah.
triple net.
So I see a lot of people do triple net deals with like 1031 exchanges. You know what I mean? Then it makes a lot of sense.
That makes a lot of sense.
Yeah. And if for anybody that doesn't know what that is, it's like you sell a property and it's deferring the taxes, on the equity that comes out of it.
Like for like. So 1031s are investment to investment. So you sell an
Yep.
investment, any monies that you earn, you put directly into another investment so you don't get hit with capital gains tax.
Right. Yeah. So you have to roll through a 1031 qualified intermediary and then they send the money. We actually, in one of our verticals that we have in house is a 1031 QM.
Oh, cool.
Yeah. So we facilitate.
We do a lot of them out here. I
Right.
actually, crazy enough, was able to do one last year, the 1031 exchange company. Like I had not heard of it, but they allowed for it. So it was a girl who had a property in Las Vegas and she had it rented and she moved to LA and she was selling the property in Vegas to buy her primary. But the property in Vegas, of course, was rental. She sold it through a 1031, even though she was purchasing as a primary, she was allowed to because the property had an ADU in back that she was going to rent. That was the same square footage as the house in Vegas.
Really? That's interesting.
Isn't that amazing?
I gotta look into that. I didn't think.
I know. I was like, this is the coolest, tricky, creative way to get around a like for like.
I gotta look into that. I didn't think there was. I mean, I've been
It
like,
goes as far.
I'll just buy an apartment building and live in one of the units, but that's interesting. Okay.
As long as the square footage of the actual, like the amount
Of the
of
rental
footage
part.
used of the rent is transferring to the new property, then you can do like for like.
Okay. All right.
I know.
All right.
And the property has to be more expensive, of course.
Of course.
So
Right. Yeah.
She was
The
getting a
same-
loan
same
on
amount.
it
Right. Yeah.
because it was like partial was becoming investment and
Interesting.
partial was becoming, I know. It's cool. I was like, are you sure?
I mean, not paying taxes is cool. So yeah.
Exactly. But it's funny because you live in a property for what you're supposed to 2 years and you're supposed to be able to take the 250,000 capital gain, basis where you don't have to pay on 250, right? And that's per individual.
Right.
And so she lived in this property in Vegas for like 7 years and moved to LA for work.
Nice.
And so she had built up her 250 in capital gain and just immediately lost it the moment that she rented Vegas.
Oh, sure.
Right. But
I'm
it
sure.
seems somewhat unfair, that just because she moved, now she loses her entire tax basis of the capital gain because she no longer.
Oh,
has
yeah. Because no longer a primary residence. Yeah.
Yeah. She lived in it 7 years, and the moment she got a lease on it, that's it. She loses the 250 capital gain basis. So
Oh, yeah. I didn't think about that. Yeah.
yeah. But we were able to work it out through the 1031. It was cool.
Good for her.
I know, good for her. I was like, no, why is this in a 1031, honey? I have it structured as a primary. And she's like, well, and I got on the phone with her 1031 company and
that's a good example of how there's never, like, I feel like there's never just one solid answer in a lot of this stuff. And if you really dig into it, there's usually like a creative way to get around things.
To make it work. Yeah, exactly.
Yeah.
Because I'm positive that you don't market 1031s in that way. But if you have a creative 1031 accountant,
I mean, I would guarantee
understands the logistics of the law.
Okay, this is a good example of what I said earlier when I talked to 4 different bankers and 4 different answers. Because if you talk to 100 different CPAs and accountants, 99% of them would just tell you that you can't do that.
Totally.
Except you get the one right guy and is, oh yeah, I know how to do that. Yeah.
We can figure that out. There's because it's a loophole.
Exactly.
Yeah, exactly. So share a specific example of how innovative problem solving has led to a success for a client, like what we just said, in the commercial way.
Okay. Innovative problem solving. So I'll share an example of a deal I did for a guy for a larger deal. And it's probably, I single-handedly made the guy like $10 million. So
let's share this story.
Yeah. So the deals I've seen that are like the best or like people that get like the most out of them is, putting land under contract on these like long-term, like land contract agreements, and then being able to rezone the properties to be worth more while it's under contract.
Oh,
and so like this guy, I won't say exactly where it was, but it was a major top MSA, and he was able to put land under contract for like $150,000. And he got like a 2-year contract from the city for the land, got it rezoned. Because it was rezoned to industrial, it was now worth like 4, something like that. So he had $4 million worth of land under contract for $150,000. He himself had basically nothing. I had significantly more than him. So I watched this go through for somebody that I had personally had significantly more than. And I was able to find a private equity company that lent him a construction loan to build like a 200,000 square foot industrial building on that site using the land using the land itself as his equity in the deal. And that building, I think the loan I did for him was about like $18 million total. And the building ended up being worth about 35. So and I think he came into the deal total for about, I don't know, 100 grand, something like that.
So you're doing construction loans as well?
Oh yeah, we do perm bridge and construction. Yeah.
Got it.
That's like a creative type of deal, like really working through it. And that took a lot of work to figure out somebody that actually do that. But that's one of the ways that like commercial real estate is like a numbers game, right? It's a math problem. And a lot of times it's just a puzzle. And if you put it together the right way, you can make things happen. That is a very unique case. I wouldn't suggest everybody go spend the next 2 years trying to do that. But, that's a unique case in commercial real estate. Some of the other stuff I see very often in the smaller balance space, like within like quadplexes and, small mobile home parks and stuff like that, is like seller financing. Like we have some like small balance programs where like if somebody wants to buy, let's say like a $500,000 property, they can finance like 70% of it with us and then get the seller to carry half of the 30% down payment. So they're coming in with 15% of the property total. So like you can get really creative like with seller financing in that way. And in this small balance space, I see a lot of people really utilize that. You can't do it with the whole thing. You got to have some money in the deal, but you can get very high, I would say like leverage from a first mortgage lender and a seller together, by using like what the seller will be able to do to make the deal happen.
Right. And there aren't the type of limitations on commercial with LTV, which is loan to value, which means how much loan there is compared to the value, or CLTV, which is combined loan to value, which is what you're talking about.
Right. There are and there aren't, but there's also a lot of ways for sellers to carry their paper, right? Like maybe you convince a guy to not do a second lien and just say like, hey, keep some equity in the deal instead, or we'll just do it on the side away from the property or something like that, right?
So they wouldn't tie the loan to the property?
Maybe not necessarily.
Got it.
If they're willing to do it, you can convince them.
But we have to see the money coming from somewhere, right? Like for
well,
us, if the purchase price is, let's say, 2 million and we're only financing 1 and he's putting 500 down, where's the other 500?
well, let's say you're like, hey, the guy's just staying in the deal. He's keeping
So
some
then he
equity.
goes on title.
Well, he won't go on title. The LLC will be on title. And he'll own some shares in the LLC or something like that.
That's where it's different than,
Right. Yeah, you can hide a lot in corporate structure.
yeah, and that's why standard mortgages don't allow it.
Yeah.
I always tell people, change title after we close. But when we're closing, it really
Right.
needs to be just tied to your name. And
Right. So, I mean, as far as title goes, like I could change the ownership of a property, like,
Right.
infinitely and not have the actual, like, owner of the property change at all, right? The LLC. But you can change
Right.
the shares, like, in the LLC as many times as you need to.
Right. Crazy. And so for the audience and even for myself always, what does like a standard commercial loan rate look like nowadays? And is it always on ARMs? Are there points? Like, what does that look like?
I would tell you that like the down the middle deal is like a 5-year fixed, 25-year amortization with the rate probably in today's world between like 6.5 and 7.25, 7.5, something like that. I think if you go out to like, if you just have, that's the average deal for the average property out there. I'm putting out rates below 6% for some deals, and I'm putting out rates above 8% for some deals. Thing is, like, and it just goes back to differences between the two industries. Residential, there's only one real like type of property for the most part, to the house. There's a bunch of different types of houses, but it's still a house.
Right.
Whereas like we do apartment buildings, office buildings, retail centers, self-storage, assisted living facilities. I mean, it just keeps going, right? And then, I also do bridge loans and perm loans and construction. And then we get into like really complicated stuff like preferred equity and mezzanine, right? So there's just so many different loan products out there. But if you were just to say, what's the average mortgage type of like rate, I'd say, between 6 and 8%. So they'll say something. So yeah.
That's great. And were rates as incredibly low on commercial as they were on residential during COVID? Like, were you guys in the 3s?
Yeah,
I didn't have time to even look at a commercial during that time. It was so zero.
Oh, I get it. I mean, the rate on my house
finances,
like 2.5%. Yeah, I mean,
yeah.
I get it. Yeah, there were some crazy low interest rates. Commercial deals. So there's still Fannie and Freddie in commercial, right? That, finance housing and apartment buildings, stuff like that. And FHA. And so, those are your tax.
Oh, yeah, yeah.
Yeah, so there are commercial sides of those. And that's where you're going to get like super low interest rates like that. Some life insurance companies were giving out crazy low insurance. Like, let's say you have some $10 million loan on like, I don't know, a $50 million building. It's pretty safe, right? So like some life insurance company would go in and just be like, hey, we just need to put our premium dollars to work. And they would give like a 3.5% rate. But for the most part, most of them were in the, 4s, something like that, low 4s. Stuff in commercial, you look at it, it's like a spread over the treasury. And like the average spread was like between maybe like 180 to 250, somewhere in there that I would see consistently, depending on where things were at.
Yeah. Last year, this is going to be way above, but last year and the year before, the spread with the 10-year was so huge for financing like SFRs and stuff for residential.
Oh, yeah.
It's like 300 bips. It had just gotten crazy.
Yeah. Yeah, it did.
Back down, but
we'll see what happens with everything that's going on now. I mean, credit spreads have not really moved, but there's just so much going on. I feel like they're going to blow out soon.
I know. I'm like kind of waiting to see if the Fed starts like buying MBSs again, like they did just.
Oh, like doing some quantitative easing?
Yes.
I don't know. It's a good
in
question.
the next year, like they backed in extremely hard and then backed out extremely hard. They were really hasty.
Yeah, they've been doing the exact, they've been letting them roll off.
So I'm just like my head, I'm like, I wonder if that's going to start again,
What's going to cause quantitative easing? All right, so moving forward, if there is, and I know a lot of people hate the tariffs and all this stuff and what's going on with the government and blah, blah, blah. But now is really the only time to do this. And it's actually the perfect time. And the reason why is because the labor market's incredibly strong. Yeah, there's some inflation, but labor market's still strong. But also the Fed funds rate's still really high, right? So you
Right.
have
And the stock market is kind of coming down.
yeah.
Very,
You have so much dry powder at the Fed to soften like a blow, right? So if the economy takes a hit, they can lower the rates 400 basis points, to help support it. So there's all this cushion there. You know what I mean?
There is. There's a ton. That's why I was saying, I do think we would see. It's just an interesting thought.
It is. There's a lot of room there. I think the Fed will step in to do more quantitative easing if, for instance, the budget deficit starts blowing out and then rates start going up because people aren't buying bonds. They're by last resort. They'll step in, they'll start buying it. But the Fed has so much room to start moving first. It'll be interesting to see what happens.
If they do, if they do. Because if inflation stays too high, then they're gonna, I don't know how quickly they're gonna move on it, but.
Yeah, it depends on which one goes first, right? Again, like the dual mandate, right? They have full employment and inflation. And since we have like stagflation, which is like slow growth and inflation, it's like very back and forth. It's like which one's worse at what time.
Every day is different.
But tariffs don't help inflation, so we'll see.
Certainly not. What did the Fed say? I loved this saying. They said, it feels like we're walking in a pitch black room filled with furniture.
Yeah.
We're walking very slowly and we have absolutely no idea what's going to hit us first.
Right. So that brings up another point. When you don't see a recession coming, you don't see a downturn coming, because when you see it coming, everybody adjusts and prepares for it. It's when you get caught off guard that like you get the margin calls and the stock market crash and this, that, and the other, right? Like a slow market meltdown isn't really a crash. I mean, it's people readjusting.
Yeah.
If there's something out there, like every time we've had a huge downturn, like 2009, like nobody saw that coming. I mean, like 3 guys did, right? But like nobody saw it coming. Or COVID, right? That's another great example. Nobody saw that coming. But so if something happens, it's going to be something that nobody can prepare for. You know what I mean? Like all the stuff that we know that's happening it's going to cause sudden correction and down.
Not like we saw it in 2008.
No.
But also it's because there's so much regulation around it, which is going away. So
right. I mean, the banks are still pretty healthy, but yes, there's a lot of stuff going away. So we'll see. We'll see.
Something's good, something's bad. You know, personally, I do feel like we were a little overregulated, but I do think that overall, people who run banks are kind of like a little greedy and will take advantage if they can. So
yeah, I think, banks are kind of like a goldfish. They grow to whatever
exactly
they're in.
If you keep feeding them, they just continue to grow. They don't know.
Exactly. Yeah, I mean, it's kind of like, that's what they're there for, right? So you can't really blame them for it. But, at the same time, you can't have them in too small of a cage or else you can't get anything done.
Right. Exactly. Yeah. Okay, so looking at my notes, did you want to talk a little bit about anything about Clopton Capital? Are you guys actual direct lenders? Because I know you have lending solutions and services. But
no, so we're not direct lenders. We're capital markets firms. So everything we do, we broker. But we're actually quite a bit larger than that. My day-to-day is financing, and that's what I started this company as. So I used to trade interest rates in 2008, 9, like 3-month, I'm dating myself here, but 3-month LIBOR, which no longer exists.
Not dating at all. I was also.
Yeah. And so I started this as just lending, right? But now we've got many different services. So we're also an insurance agency. I mentioned this before. We're a 1031 QI. We opened a brokerage sales side this year, primarily in Illinois. We also do solar, residential, and commercial, and we partner with ABGI to do like cost segregation analysis.
Oh, wow. Okay.
I've got like 1 or 2 more things we're going to bring on, and then that's it. That's enough. But, really.
Are you sure?
Yeah.
You know what I mean?
I think I'm good after that.
Sounds.
But, really what I did was I kind of looked at a closing statement one day, and I was like, well, who are all these guys that are part of these deals, and like why can't we bring everything in house? And started thinking about it less like offering different products and thinking about it more like I'm dealing with the same people, and what are the different services that these guys need and are going for. And also, lending tends to be a very long sales cycle. Like I remember this one guy, I started talking to him I did a loan for him 11 years later, and he's been in my sales force for 11 years. And like, I just touch base every couple of months,
Yeah.
But, a lot of the other stuff we do now, like insurance and property sales, allow us to like stay in contact, and I just get revenue from our existing contacts at different points in the cycle. So that's really starting to grow on itself.
And insurance it's a retention thing,
Oh yeah. Plus insurance is crazy right now.
Yeah.
So.
Tell me about it. I live in Los Angeles.
Oh yeah. Well, so here's the weird thing though. What happened in California affects the entire country, right? So think about like healthcare, right? You need the people that are low risk to offset the people that are high risk. And so when you have natural disasters in one area, it's going to affect everybody because you have to overcharge the people that are low risk to handle the people that are high risk. So
Right.
and all these companies are national companies for the most part. And the weird thing is most people don't know, all these insurance companies, then they get reinsured to the reinsurance companies. And so the whole thing's kind of tied together. So that's why people in Illinois are seeing their premiums like go up like crazy too, because of what's happening in California.
Or Florida. I mean, there are natural disasters happening all over that are costing the insurance companies everything in order
Right.
to keep up.
Yeah.
So-
And from an insurance company's perspective, like how do you insure like a total loss? You know what I mean? For like $2,500 a year.
I know.
I mean, I get
Tell
it.
me about it. I know. I have multiple clients that lost their homes. So,
I'm sure.
and clients that the insurance had just dropped them,
Right.
like that month had been dropped, and then they
I'm
lost their home.
guessing a certain company that starts with an A. Yeah. Yeah.
This one started with a G, but yes.
Okay.
But what's incredible is reinsurance. So because they had their impound account with Movement, we service as well. We had a backup insurance for them.
Oh, really? Interesting.
So they had no insurance. They lost their house completely, and we are going to fund the rebuild only. So not personal belongings, but we will fund the rebuild only based on the loan amount.
Really? Okay.
Yeah. So we're able to give them, because that's all we can insure is
Was
what
that the private mortgage insurance?
it's called PREI. It's a private reinsurance.
Oh, interesting. Okay. I didn't even know that.
And it insures our loan. That's why we can only rebuild up to how much we own of the
Oh,
property.
right. It's the mortgage insurance, basically. That's on there. Dude,
Kind of. Yeah. I mean, they didn't pay mortgage insurance. The house is worth 1.5 and they owed 562.
oh, okay. Got it.
We can do the rebuild for 562 for them.
Okay. Well, at least it's something. So.
Incredible. That will build up to most of the house, even though they ended up taking all the money,
Right.
buying a new house,
I'm sure.
and they're just going to sell the land.
Right.
It's unfortunate, but yeah. But so it's been an interesting time here that with insurance as related to insurance. Yes.
I can't imagine.
Yeah.
Dealing with insurance companies for anything is a pain, but then, yeah.
We're finding insurance. There is something called the California Fair Plan, so people can get it. It's just, I've never seen premiums this high, ever. So we're really, when it comes to qualifying a client now, I used to put like whatever in the system for insurance. And now it's a real conversation up front. I'm like, where are you looking? Is it Pasadena?
What is it? Is it like almost as much as the taxes now? Because that's, I don't know. Like,
Not quite as much, which is 1.25 or so, which is also very high. But a client of mine is buying like, what do you get? Like a 1.8, and the insurance is 8,500
ooh,
a year. Brutal. And it's not even a California Fair Plan.
that's a lot.
It's a lot.
But it's a $1.8 million house. Yeah.
No, that's a lot.
Yeah.
1.8 used to be 3,000, 3,500.
Right.
The appropriate news to this is if you're purchasing 1.8 and can afford 1.8,
You're
then
probably okay.
probably okay shedding an extra 5 a year for the insurance,
Yeah.
but still, it's
Right.
substantial, the difference.
The thing is too, like, think about if you just do the math, how long that insurance company would have to insure that house to make up for having a total loss on it, though.
Exactly. But
mean,
then where is really
It
the
would
risk?
be beyond the useful life of the house, I'm sure.
Yes, but it's not in a fire zone. So where's the risk of you losing the total house?
True. Okay. Yeah. That
You
makes
know,
sense.
Yeah. But that was high. And he told me today, we closed the loan and the insurance was $4,800 and they literally canceled him 30 days later. He called me today and he's like, my insurance.
That's happening a lot too. That's happening a lot to my commercial clients.
Oh, really?
We close a deal and then they send like an inspector out and it's literally like mundane things. They're like, hey, we didn't know there's black cats outside this property and we don't insure buildings with black cats. So we're going to drop you.
That's what they basically were like, you didn't submit pictures with the
for
application.
any reason. Yeah, it seems like. And I've had that happen to a lot of people.
With the application, our underwriters denying it.
Exactly. Yeah, exactly. And
What?
I've seen it happen just time and time again. And the other thing that is happening a lot is, people are getting their renewals like 2 days before or something like that. And like the insurance policy will jump like 100%. Yeah. They have no ability to like go and like remarket it because, they're just planning on just auto renewing. But
Right.
what can you do? You're either going to have a lapse in insurance, which is when something's going to happen.
Right.
Of course, or just deal with it. And it's a lot of people just kind of have to deal with it.
Yeah. I was telling, we get lots of mail. And since the fires, because a client of mine had her insurance lapse because she didn't open all of her mail.
Yeah.
Because she's like, how archaic. It's mail. Who mails things? And I was like, well, insurance companies do.
They sure do. And
insurance companies
why? They
mail.
continue to do it because people don't open it. And then they
You really don't get emails from an insurance company. And, I'll get an email from the mortgage company that's servicing the insurance, but not from the insurance.
No.
And so it definitely has become like you must open anything and everything that looks like an insurance bill. You must.
Yeah. Well, because, what I've noticed is in areas or property types where that insurance company kind of wanted to get rid of them anyways, I see a lot of that happening.
Yeah. Yes, of course. Yeah. Interesting stuff. Well, I'm just going to say it was really lovely chatting with you. Thank
Likewise.
you for sharing all of your information and expertise and seasoning. And it's always fun to talk with somebody who's been in the business as long as you have.
Likewise.
So I appreciate, and we'll put all of your information if anybody needs. I mean, you service the entire nation, right?
Yeah, we're pretty much nationwide in everything. And don't forget to put my content. I'm exceptionally easy to find. I'm on LinkedIn and all over the place. You can Google my name and find it. I mean, I'm always around.
Perfect. Okay, wonderful. Well, thank you, Jake. I
Likewise.
appreciate your time.
Likewise. Thank you.
Thanks for listening to Mortgage on My Mind. If you're ready to start your mortgage journey or have any questions, I'd love to help. With 20 years of experience, I make the process as simple and stress-free as possible. Check the show notes for my contact info and don't forget to subscribe, leave a review, and share this podcast. Until next time, I'm Natalie Salins, here to help make your real estate dreams a reality.